Are you better trading through a sole tradership or a limited company? Is a question I'm often asked. My name is Paul Wright of Lite Tax, and we will try and answer that for you in the next few minutes. So, let me first explain what is a limited company. A limited company is a separate corporate entity to yourself. Established in 1897 by a famous case, Solomon versus Solomon Limited, Mr. Solomon opened a company and lent it some money, on the proviso that that was a preferred loan, and if anything happened to the company, he got it back before any other creditors. So there's other creditors involved. The company actually went bust, and Mr. Solomon took his money back. And these other creditors over here weren't too happy, so they demanded the money back. It went to the courts, up to the House of Lords, where it was held that the limited company is a separate corporate entity to a sole trader or single person. So with a company, there are a few other things you can do. For instance, it's taxed differently from a sole trader. You could put personal life assurance through there and make it tax efficient for yourself. Things like mobile phones and rent of home are also more tax advantageous using a company. And the other thing is, of course, the liability is limited to the amount you put in there, unless you give any personal guarantees, of course. So let's think how a sole trader is taxed. A sole trader will typically make their tax up to the 5th of the 4th. And then that will be declared on the 31st of January the following year. On the declaration date, you will also have the pay tax and a payment on account. What's a payment on account? If you owe the taxman £10,000 you've worked out on the 5th of the 4th, when you get to the 31st of the 5th, you have to pay that £10,000 plus 50%, which is £5,000 in this case. Why do you do that? Because you've traded in this period, which is 7 months, and the taxman holds that you're going to make the same tax next year as the following year, or the previous year, so you pay 50% of it. You then make another payment on the 31st of the 7th of £5,000. That's paying towards next year's tax bill. Obviously, when next year comes around, you will deduct that from your payment, pay another payment on account. A limited company, on its commencement date, will trade for 1 year. It will strike its books off there, find out how much tax is due, and the tax is due 9 months after the year end. No payment on account unless you get into super tax structures, but it makes it a lot easier. The tax on that is 19%, corporation tax rate. Let's look at how to extract cash from a limited company. 4 basic ways. Number 1 is salary. Tax allowable within the company. Obviously, the first up to your basic rate is tax free for yourself, and that could be for you or your partner. Number 2 is rent. Now, all the costs that you have for your house, you can divide by the number of rooms. So the cost would be mortgage interest, council tax, electricity, gas. You would charge that to the company, which is allowable for corporation tax, bring that through to your own personal tax return, and put the corresponding costs in there, so cost neutral for yourself. Number 3, miles. So if you use your personal car for company business, for the first 10,000 miles, you can charge 45p. The next, over and above that, is 25p per mile. And the 4th way, available only to companies, is dividends. Again, you can split that between more than one person. So yourself and your wife, typically if you own a business between you, can take dividends. So as a sole trader, we'll put an example of an income of 70,000. From that, you would take off your personal allowance, which is 11,850. This gives 58,150 taxable income. Okay, so the basic rate is 20%, which on that is 6,900. And then you've got an upper rate of 40%. We're not going to be in the higher rate there, which is 9,460. So that gives you a total tax of 16,360. As a sole trader, you're also going to pay Class 4 national insurance on your profits, which is anything above £8,200-ish. So 8,200, 424, you pay nothing on that. And the next 37,960 is at 9%. So just check my notes, that's £3,416. And then 2% above the basic rate will give us another £472. So that gives a total of 3,888. Add those two together, and that gives total tax due of £20,248. Now we've mentioned about the payment on account, and that also applies to national insurance. So you get 50% payment on the 31st of January, which is 10124, which brings your January 31st payment to 30,372. And that 10124 is also payable on the 31st of July. So the limited company, we're going to earn the same £70,000. Yeah? Now instead of having tax-free income, we'll take it off as a salary. 11,850. And also you can pay that extra rent as a limited company, as we already discussed. And let's say it's £3,000 in this case. So that gives you company corporation tax of 55,150. Times that by 19%, which is actually going down to 17% by 2020, and that gives us corporation tax payable of 10479. Now, if you take no money from the company, say if you're trying to build it up, or you've got income from elsewhere, that is the total amount of tax you pay. No payment on account, payable 1 year and 9 months after the year end. But you're going to want to take money from the company. Well, we've already taken the PAYE out, and the rent, and both companies will take the mileage out for. So you've got 44,672 left to distribute. Take a dividend, which is the fourth way of taking money out. The first 2,000 is nothing, so that's free. Yeah. Then up to your basic rate of tax, it's 7.5%. So in this case, it's 34,500 at 7.5%, which is 2,588. And then over that amount there, it is 32.5%, which in this case is 2,656. Now what we'd usually do is limit the dividend, if we can, to this amount. So usually you've got about 4,000 a month, 5,000 a month you can take from the company, or bring a partner, second shareholder. Now, there's a little bit of payment on account to pay on your dividend tax. So January would be these two here, 50%, 2,622 payment on account. And in July, 2,622. So the total tax in this case is nearly £40,000, and in this case it's 20,965. It's not quite as bad in the second year, but the first year is the most drastic year for paying tax if you're a sole trader, compared to a limited company. So let's just summarise. As a sole trader, earning 70,000 a year, in the first year your tax liability will be 2248, which, if we add the payment on account, doubles it in the first year, 2 lots of 50%. As a limited company, if you took no profit from a limited company, took no cash from a limited company, that's your corporation tax, 10479. If you took cash out, if you took £36,000 out, it would cost you 2588. And there is a bit of payment on account on that one, 50% plus 50%. Benefits of being a limited company, just to surmise, a limited company, you have limited liability, so if anything goes wrong within the company, technically you're not liable to it. You've got a few other tax benefits like life assurance, phones, rent. Couple of downsides. A limited company, you can't take dividends more than the profit you've made cumulatively. Having said that, that would be the same as a sole trader. You're relying on your bank overdraft or your bank manager's goodwill to take more than that is profit. The cost. Typically, for a small tradesman who or a contractor, the cost of a sole trader will be 500p plus VAT. A little bit more work to do with a limited company. We need to keep your payroll, we need to do statutory accounts, your annual return, your CT600, which is your company tax return. That would usually be about 1,200 plus VAT, and there's a £400 setup fee to put the limited company into action. My name's Paul Light. If you need any more information on there, please contact me now.